Human nature craves excitement. From the grandest endeavors to the simplest pastimes, we are drawn to action, drama, and the thrill of rapid movement. This instinct, while essential in many aspects of life, is a fatal flaw when brought to the world of financial markets. The average trader, guided by this innate desire for activity, is psychologically programmed to fail. He is attracted to the market when it is most exciting, at the peak of a speculative mania, amidst headlines of soaring prices and easy fortunes. He buys into the euphoria. Conversely, he is repelled by the market when it is most frightening, during the panic of a great decline, and he sells into the capitulation. He buys excitement and sells despair. The professional philosophy of William Delbert Gann is a complete and total inversion of this self-destructive instinct. He taught that the greatest and safest buying opportunities are born not in the heat of a speculative fever, but in the cold, quiet stillness of a market that has been forgotten. The secret to great wealth, he knew, is found not in excitement, but in what the public perceives as profound, agonizing boredom. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand the psychology of accumulation, one must first conduct a deep and unflinching analysis of the public's psychological journey to the market bottom. This is the anatomy of capitulation. William Delbert Gann, in his masterwork Truth of the Stock Tape, provided a clinical roadmap of this process through his concept of the 7 zones of activity. The journey into the depths begins after a market top, as the stock enters the first and second zones below normal. The initial decline is often met with disbelief and hope. The public, who bought near the highs, views the drop as a normal reaction, an opportunity to buy more at a cheaper price. They are still conditioned by the previous bull market and cannot yet conceive of a major trend change. As the decline continues into the second zone, hope begins to curdle into anxiety. The rallies become weaker and shorter, and the declines become sharper and more severe. Liquidation increases, Gann wrote, and breaks become bigger. The trader who held on, hoping for a return to the old highs, now finds himself in a significant losing position. His anxiety turns to fear. He watches the ticker every day, his emotional state rising and falling with every minor tick. He is no longer making rational decisions. He is a prisoner of his losing position. This grinding, painful decline culminates in the final catastrophic phase, the third and final zone below normal. This is the zone of pure panic. William Delbert Gann described it with chilling accuracy. It marks a period of panicky conditions, extreme pessimism. Investors lose confidence and start selling out. The last thread of hope is severed. The news, which may have been mixed, now becomes uniformly terrible. Reports of poor business, reduced earnings, and cut dividends fill the newspapers. The economic outlook is dire. The trader who has held on this long is now at his breaking point. His fear is magnified by the forced selling of others who are receiving margin calls. The supply of stock seems limitless. A feeling of utter hopelessness takes hold. The narrative shifts from "the stock will come back" to "the company might go bankrupt," or "this stock is not worth the paper it is written on." This is the moment of capitulation. The trader can no longer bear the financial and emotional pain. He sells. He sells not because of a reasoned analysis, but as a purely emotional act of self-preservation to make the pain stop. He sells for any price he can get, joining the cascade of liquidation that defines the panic bottom. It is at this point of maximum pessimism, when the last of the weak holders has been forcibly washed out of the market, that a profound change occurs. The intense, high-volume selling of the panic phase suddenly ceases. The reason is simple. There is almost no one left to sell. The supply of stock that was weakly held has now been completely exhausted. And what follows the storm is not an immediate and vibrant recovery, but a period of profound and eerie quiet. This is the boring phase. The public, having been financially and emotionally traumatized, turns away from the market in disgust. They no longer want to hear about the stock they just sold for a huge loss. They no longer watch the ticker. Their interest is gone. The very instrument that was the source of so much intense emotion, first greed, then hope, then fear, then panic, is now met with a wall of complete and total apathy. This psychological withdrawal of the public is the direct cause of the boring market. The volume of sales dries up, the price fluctuations become narrow and lifeless, and the stock disappears from the headlines. The great drama is over. And it is in this quiet, forgotten graveyard of the old trend that the seeds of the next great bull market are sown. This quiet, narrow, and low-volume market that follows a panic is almost universally interpreted by the remaining amateur observers as a sign of profound weakness. This is the second and most subtle psychological illusion that allows for professional accumulation. The amateur's mind associates opportunity with activity. He is drawn to stocks that are moving, that have wide ranges, high volume, and are making headlines. A boring stock offers none of these things. Its narrow fluctuations offer no quick scalping profits. Its low volume suggests a lack of interest and power. It appears to be a dead stock, an asset that has been abandoned by all intelligent capital. This perception is a critical error in judgment, a fundamental misreading of the market's language. It is this very illusion that William Delbert Gann sought to correct. He wrote explicitly, "Often when stocks look the weakest on the tape, they are the strongest as accumulation is taking place." The professional operator, the composite man, understands this psychology perfectly and uses it to his advantage. The boring market is not a sign of weakness to him. It is the perfect operating environment. It is the camouflage that allows him to execute his campaign of accumulation without alerting the public and without bidding up the price against himself. In this quiet market, he can absorb the last trickles of selling from discouraged investors, patiently accumulating a massive line of stock over a period of weeks, months, or even years. The public's disinterest is his greatest asset. He does not want excitement. He does not want high volume. He wants a quiet, orderly transfer of shares from the weak hands who are disgusted with the stock into his own strong, patient hands. This is why the trader must train himself to act as a contrarian, to see what others miss. He must learn that after a long decline, dullness is not weakness. It is a sign that the selling pressure has been exhausted. He must understand that a narrow trading range is not a sign of a dead stock, but often the sign of a foundation being laid. The lack of volatility and excitement is a psychological barrier that keeps the amateur out of the market at the very best time to be getting in. The professional, however, has the knowledge and the discipline to recognize these quiet periods for what they are, the phase of preparation, the silent coiling of the spring before the next great advance, the ability to overcome the natural human instinct to seek excitement, and to instead cultivate the discipline to buy when the market is at its most boring, is one of the greatest secrets to the success of William Delbert Gann. It is the art of recognizing that the greatest strength is born in the quietest moments. While the public turns away from the market in a state of apathy and disgust, the professional operator, the insider whom William Delbert Gann personified as the composite man, begins his most important work. His actions are the direct inverse of the crowd's. He does not see the dull, lifeless market as a sign of weakness. He sees it as the perfect environment for his campaign. This boring period is the phase of accumulation. Having sold his shares to the public at the euphoric top of the previous bull market, his objective now is to buy them all back at the lowest possible prices in preparation for the next great advance. The public's disinterest is not an obstacle. It is his greatest strategic asset. It provides him with the one thing he needs above all else: time. A large, informed operator cannot simply enter the market and buy hundreds of thousands of shares at once. Such an action would create a massive spike in demand, causing the price to rally sharply against him. His goal is to accumulate his full line of stock with as little upward pressure on the price as possible. A quiet, inactive, boring market is the ideal camouflage for this operation. In this environment, he can patiently absorb the steady, light trickle of selling that comes from the last of the discouraged and disillusioned holders. Day after day, week after week, he places his bids at the support level, quietly soaking up all the available supply. He does not chase the price up. He allows the stock to drift in its narrow range, letting the profound dullness of the market do his work for him by extinguishing any remaining public interest. The amateur sees nothing happening and moves on. The professional sees a foundation being methodically laid, and he acts with the quiet confidence of a master builder. This is the great counteraction that takes place beneath the surface of a boring market. The professional trader, seeking to align his actions with those of the insiders, must learn to read the subtle but definite signals that this quiet accumulation is taking place. These are not the loud, dramatic signals of a market top, but the quiet, almost invisible whispers of a market bottom. William Delbert Gann, through his intensive study of the tape, identified two primary chart and volume signatures that confirm that a boring market is in fact a market under accumulation. The first and most important of these is a prolonged period of narrow fluctuations and dullness after a long decline. After the final panic of the third zone has subsided, a stock will enter a phase where its price movement becomes extremely constricted. It will trade for weeks and often for many months within a very narrow horizontal range. The exciting, wide swings of the bull market are a distant memory. The stock is now lifeless, often moving less in a week than it once did in an hour. Crucially, this narrow price action is accompanied by extremely low volume. William Delbert Gann considered this combination to be one of the most reliable long-term buy signals. He wrote, "When a stock or group of stocks on averages remains for a long time in a narrow range and the volume of sales is small, it is a sign that accumulation has run its course and the market is getting ready to turn. The logic behind this signal is a direct reading of the law of supply and demand. The narrow price range indicates that the forces of supply and demand have reached a state of equilibrium. The sellers are no longer powerful enough to push the price to new lows, and the buyers are not yet aggressive enough to push it to new highs. They are simply absorbing whatever supply comes to market at a fixed price level. The low volume is the key confirmation. It is the market's own testimony that the selling pressure has been completely exhausted. All the forced selling from margin calls is over. All the panic selling from terrified investors is over. The only sellers left are the last of the thoroughly discouraged holders who are liquidating out of sheer exhaustion and apathy. Their selling is not aggressive. It is a weak, sporadic trickle. The professional accumulator can absorb this light supply with ease, without creating any significant price movement or volume spikes. This long, quiet, boring period is the signature of a successful accumulation campaign. It is the sign that the stock has been fully transferred from weak hands into strong hands, and that the path of least resistance is slowly but surely turning from down to up. The second, and often final confirmation that accumulation is complete, is the successful test on low volume. After a stock has established its initial low in a period of either panic or dullness, and has had its first preliminary rally, it will almost invariably drift back down to re-examine that low. This test is a critical moment that reveals the true state of supply and demand. The professional analyst watches the volume on this secondary decline with the focus of a hawk. A successful or bullish test must occur on significantly less volume than the volume that formed the initial low. This is the definitive proof that the sellers are gone. Let us construct an example. A stock makes its final panic low at $20 on a climactic volume of 500,000 shares. It then rallies to $25. Over the next several weeks, it slowly drifts back down and touches the $20 level again. The trader checks the volume on the day of this test and sees that it was only 50,000 shares. This is an exceptionally powerful buy signal. The drastically lower volume on the second test is the market's irrefutable evidence that the intense selling pressure that existed at the first low has now completely vanished. The supply of stock at the $20 level has been dried up. This low-volume test, especially when it forms a double bottom where the second low holds at or slightly above the first, is the professional's signal to act with confidence. It confirms that the accumulation phase is nearing its end and that the insiders have absorbed all the available stock. It shows that the sellers have lost their power and that the slightest increase in demand is now likely to start a sustainable advance. The amateur, seeing the stock return to its old low, is overcome by fear, believing the breakdown is finally coming. The professional, by reading the story told by the volume, understands that he is not witnessing weakness, but the final, quiet confirmation of underlying strength. Applying these strategic rules with a master's precision requires the ability to grasp the dynamics behind every price movement. William Delbert Gann's Truth of the Stock Tape is the foundational guide for this skill. It's not a book of theory, it's a practical course that teaches the reader to understand the real-time contest between buyers and sellers, recognize the critical phases of accumulation and distribution, and assess a trend's true strength. This edition is a faithful reproduction of the 1923 original. The historical charts from that 100-year-old publication are included. While many are difficult to read, their inclusion was deemed important for historical context. The true timeless value, however, lies in Gann's text. For any serious student ready to understand the market's real intent, this book is an essential resource. Get your copy via the link in this video's description. To know the signs of quiet accumulation, the narrow fluctuations, the dullness, and the low-volume tests is a matter of technical knowledge. It is the science of reading the chart. But to act on that knowledge, to actually commit your capital and buy a stock when it is universally despised, forgotten, and appears utterly lifeless, is another matter entirely. This is the great psychological leap that separates the amateur from the professional. It is one thing to understand intellectually that a boring market is often a bullish one. It is another to possess the profound psychological fortitude to act in direct opposition to every human instinct and all prevailing public opinion. This final section is dedicated to that challenge, the psychological shift required to act against the crowd and the final, decisive signal that transforms a long period of patient waiting into profitable action. The human mind is not wired for contrarian thinking. We are social creatures, hardwired to seek safety and validation in the consensus of the crowd. When everyone is bullish and excited about a stock, it feels safe and correct to buy. When everyone is pessimistic and fearful, it feels dangerous and foolish to do anything but sell or stay away. The act of buying a stock that is boring, a stock that no one is talking about, that has been declining or moving sideways for years and that is associated in the public mind with loss and disappointment, is an act of profound professional isolation. It feels wrong. It feels lonely. Your instincts, your friends, and every headline in the newspaper will scream that you are making a mistake. This is the ultimate test of a trader's conviction. It is the moment where you must decide who you are going to trust. The emotional, story-driven narrative of the crowd, or the cold, hard, factual evidence on your charts. The professional, as defined by William Delbert Gann, has made this choice long in advance. His actions are not guided by feelings or opinions, but by a definite set of rules and a deep study of market history. He knows that the market bottom is not an event, but a process, and that the phase of accumulation is, by its very nature, a quiet and boring affair. He understands that this dullness is not a sign of weakness, but a sign that the selling pressure has been exhausted. He has the knowledge to recognize the subtle chart and volume signatures that confirm this. Therefore, when the time comes to act, he has the courage to do so, not because he is a natural-born contrarian, but because he has done the preparatory work that gives him a foundation of knowledge and a reason for his actions. He is not guessing. He is executing a well-defined plan. To illustrate this entire process, the immense psychological challenge and the scale of the eventual reward, There is no greater case study than the one William Delbert Gann himself provided in his masterwork, Truth of the Stock Tape. It is the multi-decade story of corn products refining company. This single, detailed example is the ultimate lesson in the psychology of accumulation. The story begins, as many market cycles do, at the peak of a bull market. In 1906, corn products was an established industrial stock, and it made a major high for that year at $28 per share. Then came the panic of 1907, and the stock collapsed, plunging to a low of just $8. This catastrophic decline marked the beginning of its long, dark winter. For the next 10 years, from 1907 to early 1917, corn products was the very definition of a dead and boring stock. It was a laggard, a profound disappointment to anyone who owned it, and a stock that was completely ignored by the speculative public who were chasing the exciting new leaders of the day. Let us place ourselves in the mind of a trader following the methods of William Delbert Gann during that decade. After the crash to $8 in 1907, the trader would have begun his patient observation. The stock staged a feeble rally to $26 in 1909, failing to surpass its old 1906 high, a clear sign of profound weakness. It then fell back again, declining to $10 in 1911 and then all the way back down to its old low of $8 in 1913. This formation of a massive double bottom over a 6-year period would have been the first major signal to the Gann analyst that a final absolute floor was being established. This was a sign that at $8, a powerful, informed interest was willing to absorb all the available supply. For the next 4 years, the stock drifted lifelessly, trading mostly between $8 and the low 20s. This was the heart of the boring period. Imagine the immense psychological discipline required during this time. While other stocks were beginning to make exciting moves, corn products was stagnant. The volume was low, the fluctuations were narrow, and it was completely absent from the financial headlines. The amateur trader would have dismissed it as worthless. But the professional, reading the tape, would have seen the truth. He would have seen the quiet, methodical process of accumulation. He would have seen the lack of any significant selling pressure on declines. He would have recognized this long, quiet, boring period not as weakness, but as the construction of a massive foundation, the coiling of a spring for a move of historic proportions. After a decade of patient preparation, the final signal came. This is the moment that all the waiting was for, the breakout. In 1917, the quiet buying pressure that had been working for 10 years finally grew strong enough to overwhelm the last of the overhead supply. The price of corn products began to advance with a new energy. It rallied up to its old decade-long resistance level at the 1906 high of $28. Then it broke through. This was the definitive, unambiguous signal that the 10-year period of accumulation was complete, and that a new, powerful markup phase, its growth phase, had begun. This was the moment for the professional trader to act with decisive force. The time for quiet, exploratory buying was over. The time for aggressive, confident pyramiding had arrived. The move that followed the breakout was a testament to the immense power that is stored during a long and quiet accumulation. Freed from its 10-year base, corn products began one of the great bull markets of its time. It continued to make higher tops and higher bottoms, advancing relentlessly. By the spring of 1920, it had reached a high of $105. After a normal cyclical correction during the 1921 bear market, where it found support far above its old breakout level, it resumed its advance with even greater force. In October of 1922, corn products reached a final high of $134 per share. From its accumulation era lows, the stock had advanced by more than 1,500%. The decade of boredom had given birth to a legendary bull market. This is the ultimate lesson in the psychology of accumulation. The greatest opportunities in the financial markets are not found in the noise, the excitement, and the feverish activity that the public craves. They are found in the quiet, the dullness, and the profound apathy that marks a true market bottom. To capitalize on these opportunities requires a complete inversion of human instinct. It requires the knowledge to recognize the subtle technical signs of professional accumulation when the market appears at its weakest. It requires the patience to wait, sometimes for years, while this foundational work is being completed. And it requires the courage to act on your analysis, to step forward and buy when every emotional impulse and the entire weight of public opinion tells you that you are wrong. This is the discipline of the master trader. It is the understanding, as taught by the lifelong work of William Delbert Gann, that the greatest fortunes are not chased in the heat of the bull market's final glorious peak. They are quietly and methodically born in the silence of the bottom.